Hi, I'm Andy Temte, and welcome to Money Lessons. Join me every Saturday morning for bite-sized lessons that are designed to improve financial literacy around the world. Today is January the 17th, 2026. Last week, we concluded our journey through bond market history by discovering how World War II debt, institutional investors, electronic trading, and exchange-traded funds, or ETFs, transformed bonds from elite investments into accessible tools that anyone can use. Today's $55+ trillion bond market, which rivals the stock market as one of the two pillars of U.S. securities markets and global securities markets, well, it represents the culmination of reforms dating back to the Great Depression and technologies that democratized access. But here's the question that we haven't answered yet. What exactly are you buying when you purchase a bond? Today, we're opening the hood to explore bond mechanics, the nuts and bolts of how these instruments actually work. So, what is a bond? At its core, a bond is remarkably simple. It's an IOU. When you buy a bond, you're lending money to someone, a government, a corporation, or a municipality, and they are promising to pay you back with interest. Think of it this way. If you remember back to our August 2nd, 2025 lesson on how we explored interest as the price of money, well, a bond is that concept formalized into a legal contract. You give the borrower your money today. They promise to make regular interest payments and return your principal on a specific future date. This is fundamentally different from buying stock, where you become a partial owner sharing in profits and losses. With a bond, you are a creditor with a legal claim to specific promised payments, regardless of how well or poorly the borrower is doing financially, unless they default entirely, which we explored in our December 20th episode with France's two-thirds bankruptcy. Now, every bond has three numbers that define it. The first is face value, which is also called par value or the principal value. This is the amount the borrower promises to repay at maturity. Most bonds have a face value of $1,000. This is what you'll get back when the bond matures, assuming the borrower doesn't default. The second number that we look at is the coupon rate. This is the annual interest rate the borrower promises to pay, expressed as a percentage of face value. A bond with a 5% coupon pays 5% of its face value in interest each year. The term coupon comes from the days when bonds had physical coupons attached to them that you'd clip and mail in to receive your interest payment. Fun fact, this is where the phrase clipping coupons originated. Now, the third number that we care about is the maturity date. This is when the borrower promises to repay the face value. Bonds might mature in 1 year, 5 years, 10 years, or 30 years. And let's use a concrete example. Suppose we have a $1,000 face value bond with a 5% coupon maturing in 10 years. This bond will pay you $50 per year in interest, which is 5% of $1,000 for 10 years, then return your $1,000 principal back when it matures. Now, most bonds pay interest semi-annually or twice per year. Our $1,000 bond with a 5% coupon would pay $25 every 6 months rather than $50 once annually. This practice became standard with U.S. Treasury bonds in the early 1800s and was adopted by railroad companies when they began issuing bonds in the 1860s. For example, Pacific Railroad bonds from 1865, well, they paid interest every May 1st and November 1st, a pattern that continues in bond markets today. So, picture owning this bond. Every 6 months, a payment of $25 arrives in your account. This continues like clockwork for 10 years, 20 total payments of $25 each. Then, with the final interest payment, you also receive your $1,000 face value back. But what we need to really understand with bonds is the bond pricing and the concepts of premium and discount. While the face value stays constant at $1,000, bonds don't always trade at their face value. They trade at current market prices based on current market conditions. When a bond trades at its face value, or $1,000 in our example, it is trading at quote-unquote par value. When it trades above par value or face value, say $1,050, it's trading at a premium, and the premium is $50. When it trades below face value, let's say $950, it's trading at a $50 discount. Now, why would you pay $1,050 for a bond that only returns $1,000 at maturity? Because that bond's interest payments might be more attractive than what newly issued bonds are offering today. Why would you only pay $950 for that bond? Because that bond's interest payments are less attractive than current alternatives. Now, this brings us to the single most important concept in bond investing, and that is the inverse relationship. When rates rise, prices fall, and vice versa. This is the relationship every bond investor must understand. When rates rise, existing bond prices fall. When interest rates fall, existing bond prices rise. Now, let's see why this happens using our example. Suppose you bought a $1,000 bond with a 5% coupon when it was issued. It pays you $50 per year. You paid $1,000 for it, so your yield is 5%. Now, let's suppose that interest rates rise shortly after the issuance of your bond, and new bonds with similar risk profiles are being issued with 6% coupons. New investors can buy a $1,000 bond that now pays $60 a year and not the $50 you were getting. So, what happens to your bond paying only $50 per year? Nobody will pay you $1,000 for it when they can get a new bond paying $60 annually for the same price. Your bond must trade at a discount. The market will price your bond so that its yield matches current rates. Using present value calculations with semi-annual payments over the remaining 10 years of your bond would trade at approximately $926, where the $50 annual interest plus the eventual return of the $1,000 face value provides a 6% yield to maturity, which is the current market interest rate. Here, note that the discount from par value is $74, or $1,000 minus $926. The reverse is equally true. If interest rates fall to 4% right after the issuance of the bond that you bought, and new bonds pay only $40 per year, your bond paying $50 becomes more valuable. Using the same present value approach, investors would pay approximately $1,082 for your bond. Here, the premium relative to par value is 82. 1,082 minus 1,000. This inverse relationship exists because bond interest payments are fixed, but market interest rates change constantly. The price adjusts to keep yields competitive with current rates. Now, some of you may be saying, hey, wait a minute. In your example, the interest rate change was 1% up or down, but the discount and the premium are not mirror images of one another. For a 1% increase in rates, the discount was 74, but when rates decreased by the same amount, the premium was bigger at 82. This is because the price-yield function is nonlinear. In future lessons, we're going to talk about bond duration and bond convexity as measures of interest rate risk. So, why does this matter? Understanding bond mechanics is essential for making informed investment decisions. When you hear in the news that the Fed raised interest rates, you now understand that existing bond prices fell. When the financial news discusses yields rising, you know that bond prices are falling. But what exactly is yield? I've used that word several times today, and you may have noticed that there's a lot more to unpack here. Next week, we'll explore the different ways to measure yield: nominal yield, current yield, yield to maturity, and yield to call, and discover why comparing the right yields is essential for evaluating bond investments. Until next week, I wish you grace, dignity, and compassion. My name is Andy Temte. This is Money Lessons. You can find the show on all the major streaming services as well as out on YouTube. Please like, subscribe, rate, and most importantly, share this public good with your friends, your family, your colleagues, and maybe a neighbor. The show was produced by Nicholas Temte, and we'll see you next time on Money Lessons.